Okay, folks, welcome back. This is our price action model number 3 swing trading plan. And the objective is to focus on moves that are 100 to 300 pips per trade. Alright, so the ICT price action model number 3 swing trade plan, 100 to 300 pips per trade. As I've already warned you in the 2 previous trade plans, the slides are going to be repetitive. Okay, so to circumvent the need to keep saying this each time, just prepare yourself again, because what I'm doing is I'm building out my entire perception of the marketplace. So every time we add a new trade plan, I'm adding things to an existing format, so that way you'll see how all of these models actually dovetail. And I've said this before we started doing them too. During the core content, as we were going through it in the latter stages, I said that we would go into trade plans that would, after you see them all, you'll understand how they all are modular. They can be broken down in individual trade plans, or as I'm developing it, as we go through all 12 of them, all of these models take shape, and I'm utilizing them to some degree all the time. By understanding all of them in a complete and concise manner, it gives you a comprehensive overview of what it is I've been teaching in the mentorship. And then from applying your personality, your affinity for one time frame over another, a style of trading that is more appropriate for your lifestyle and your existence as a human being, not just a trader, because all of us have different walks of life. We all have different constraints that we have to operate in, and not all of us have the luxury to sit down in front and watch live 1-minute charts and 5-minute charts. We don't have that. We have businesses, we have jobs, things that take our attention elsewhere. So while it may not be possible for you to take action in one particular approach of trading, like scalping or day trading, it's advised for you to understand how that is done, because if you do this long enough, eventually you will have the opportunity to do those types of things. And whether you stay in that classification as a day trader or a scalper will remain to be seen, in your own development. Not every one of you are going to do it. Some of you came into this mentorship with the expectation you're going to do one format or a style trader, and you probably watched that morph over the year or so that we've been working together, and you've changed different styles and approaches to see what suits you. When we have completed all 12 price action model trade plans, you'll see the whole collection of disciplines, of specific concepts. Now, it's not my objective to try to implement every single facet of the ICT mentorship. Some of you are saying, okay, he's given me every one of these tools, every one of these applications, every one of these conditions for this or that. So what he must be saying is, there's a situation where it allows me to toggle all these boxes and check them all off, and that's the perfect $1 million trade. That's not how it works. You are going to see how using a scalping mindset or approach or process or protocol utilized in this model, because I'm going to talk about where you would implement that. You can also take this strategy and zoom it out to a weekly chart and trade long-term position trades. Okay, so that's the understanding I'm giving you, but you're probably just focusing on specifics and looking at he says a weekly chart or a monthly chart, so it should only work there. No, it's completely universal, because price action is fractal. when you understand how we can operate on a macro level with this model, don't forget how you can go back in using the short-term concepts that you learned in the core content and in the previous short-term model trade plan and in the scalping trade plan. All of those ideas can be used to complement this model. Okay, and don't limit yourself to just that, because you'll find as I go back into another swing trade plan later on in the year when we get to that, you'll see that I'm going to be bringing in other things that you've seen me talk about in swing trading that haven't made their way into this one yet. So again, this is it's a complete progressive unveiling of how I sit down and look at a market. I get lots of questions. How do I know when to go into a trade as a day trader or a scalper or a short-term trader? Or when is it feasible for me to be in a swing trade mindset? Okay. Those answers are provided by going through these 12 trade plans and then experiencing them yourself, because I have an understanding of what it means to me, but it's literally impossible for me to articulate that in a way where it's going to be appreciated or understood. And I'm not saying that I'm so intellectually lofty, okay, that you can't grasp what I'm going to say, because I'm not a mental giant, clearly. But it's something you have to experience yourself, and then you'll understand what it is that I'm saying. And what is it I'm trying to say is that you're going to understand more about how to view price by the way I'm showing you this and repetitively repeating a lot of the same things, like this slide you're looking at here. It feels like cutting corners. It feels like holding information back. It feels like all those things because you're on that side of your understanding. But when we go through the entire 12 trade plans and then we implement the algorithmic principles that will be applied to each one of them as well, but not in such a long drawn out process, the understanding you'll have and the ability to read price in moments of just sitting down and looking at the charts, working from a monthly down into a 1 or 5 minute chart, you'll know right away what you should be doing relative to position trading, swing trading, short-term trading, intraday scalping. You'll know what it is that you're going to be most likely to elect as the mode of engagement for that particular time, which gives you a well-rounded, holistic approach to analysis. It's not just simply a top-down, but you'll understand not only top-down, but you'll know what it is that you'll reach for that has the highest probability of panning out. Because let's face it, not every market is a long-term position market. You have to go through long periods of consolidation or reversals and just really ugly market price action. So there's always a scalper's mentality, okay, available to any market environment. That's always there, which is the primary reason why I like to teach with intraday charts. That's the reason why I taught the first trade plan as such. That's the reason why I taught in my free YouTube channel the scalping series, because it is absolutely essential to understanding price action, because it gives you the repetitiveness of seeing things pan out over and over and over again. Much in the same way I'm delivering these trade plans. They're going to look almost identical. There's a couple little variations here and there, but because I'm forcing you to go through them at the minimum 12 times, the retention of specific things that most of you aren't paying a lot of attention to or minimizing in your approach to digesting this information, it forces you to have it subconsciously. And then when you watch price action live and you're looking at charts develop in real time, your ability to recall this information and these specific protocols that make these trade plans will be called into action. And it won't be like, oh, I got to think about it. It'll just happen because you have been forced to learn it this way. Okay? So, again, like we said in the previous 2 trade plans, and I'll say this another 9 more times, but the cycle for every trade plan is preparation, opportunity discovery, trade planning, trade execution, and trade management. All right, so with our preparation, we always refer to our economic calendar for the coming week. We want to note all medium and high impact events for the markets that you are following. Study the events on the week to come and consider how the current market structure and the calendar events may suggest a specific weekly profile for that week's range. Now, remember, this trade plan or price action model that we're fleshing out into a trade plan is specifically aimed at trading in the direction of a monthly range. Okay, so don't let this fool you here. You still have to flesh out that monthly range with 4 weekly candles. So we're still keeping that in the forefront of our mind. Okay, so again, moving into the up-to-data ranges. Now, because we're working with swing trading, we're working primarily with a larger degree of price and duration looking back. So while we've been primarily looking at the last 20 days up-to-data range, in terms of look back, we're focusing on and bringing in the full spectrum of 20, 40, and 60 trading days. So while the depiction here is basically the same, what we're saying is today, if we look back, is 20 days. If we don't see any up-to-data ranges that work for our top-down analysis, we go to the 40-day look back. And if we don't see anything that's notable, then we'll look back 60 trading days. Okay, so we're not counting Sundays, but we're going to be noting the highest high and the lowest low in the past 20, and that little asterisk next to that 20 is implying that we're referring to not only just the 20 days look back, but as much as up to 60 days look back. Okay, so while this indicates what we've shown in the previous trade plan, the graphic that I created here, all I'm trying to do is save myself a lot of legwork and just ringing in the reminder that the maximum up-to-data range is referred to here because we're in swing trading. So again, whenever we sit down in front of our charts, we're calling that today. Our look back is 20 days, not counting Sundays, and then we look back 40 days if there's nothing that we can really work with in terms of the 20-day up-to-data range. And then if 40 days doesn't give us anything to frame a context on, we'll look back to 60. Okay? That's your current dealing range, knowing the highest high and the lowest low in that 20, 40, or 60 days respectively. Defining these highest high and lowest low, that's going to be the range you work within for looking for your entries, looking for your targets, and not only your terminus where you expect to see the trade go to ultimate objective, but where along the way you should be looking for potential partials to take in profit. Now inside this dealing range, we look for the next draw on liquidity. Where is price likely to trade to next? An old high or low, a fair value gap, or a liquidity pool. We look for a PD array in the direction of the monthly range bias. Now, what does that mean? Did I just create something new for you to understand or wrestle with? No. The same things that we talk about on a 15-minute time frame that makes up our intraday daily fluctuations and ebb and flow that create the daily range, it's the same context, okay, we're looking at for a monthly range. So all the things that we look for on any other time frame, we're looking for it to occur on the monthly range. The premium PD arrays when bullish and discount arrays when bearish are going to be focused on. Okay, preparation. We anticipate price to move to a PD array that would support our monthly bias on a day and an economic event found on the economic calendar with the current or next trading week. This is what we are waiting for. Okay, we're looking for a convergence of the right kind of news, high impact or medium impact, that's going to stimulate volatility in that particular market. Now, by itself, it doesn't mean much. We're going to bring in another component But that's what we're primarily looking for. We're looking for that smoke screen that the central banks will use in the form of the economic calendar, medium or high impact event. Now, this can either be a run on liquidity or a rebalancing inefficient price delivery. Opportunity discovery. What we're going to be focusing on for swing trades is we're going to be identifying the current seasonal tendency for the time of your price action study. So if we're looking at a particular market, for instance, say we're looking at the euro, you want to go through your core content and go to the section where we talked about seasonal tendencies. And there are two areas where I talked about it, where we talked about mega trades and the month 5 content, where I actually rung in seasonal tendencies as a general idea. You want to be looking at the highest probability seasonal tendencies that suggest a strong chance of bullishness or bearishness at that current time. What's the current time? The time when you're sitting down in front of the charts. What month are you in? Okay. What time? What season of the year are you in? Are you in the spring decline, or are you in the fall rally? Okay, that's seasonal tendency for the year that we look at, the money cycle. We're looking for the individual quarterly effects. Okay, there's quarterly shifts that take place in the marketplace. We want to be looking at what is the strongest one right now. So at the time of this recording, it's the latter portions of March 2020. So I would be looking at what seasonal tendencies are going to be highly probable for the month of April and May. So the seasonal tendencies that are strongest in those periods, that's the markets I want to be focusing on. And if it lines up technically with if the data ranges as I outlined, and other factors we'll cover in this trade plan. But we're focusing and limiting our focus to the highest probability. We're not trying to just sit down and do some willy-nilly trades. Swing trading requires a lot more analysis. It requires a lot more patience, and you're going to have to demand a lot of things to happen. Okay, we're going to identify the discount arrays under the 20-day asterisk, which means if it's not 20 days, 40 days, or up to 60 days, if the data range, when the bias is bearish. And we're going to identify the premium arrays inside the 20-day, 40-day, or 60-day, if the data range, when the COT hedge program is bearish. We're going to be expecting a monthly range expansion down. Now, as you can see here, this is the crude depiction I gave when we are utilizing the COT hedge program. And that's my way of interpreting commitment of traders, where we're only looking at the commercials and we're not looking at the large specs or low interest small specs. We care less what they think, because that's street money. We're looking at the 12-month look back on that commercial activity, and we get the highest high and the lowest low of where they have placed their net position, and then we split that range in half, and then we look at where we have recently traded to. Are we at the lower end or above that central line? Okay, because that's going to denote whether they're primarily hedging long or hedging short, regardless of their natural net position that you would see in a classic net trader's position chart or graph. Their net zero line is of no interest to me. I could care less about that. What we do, and it's mentioned in the core content, so you'll have to go back through and look at it. And where you find that is in the commodity section. It should be, what would that be? I know it was June of 2017 when I did the content, so you'll have to look at it and just know that it's the month where we did bonds, stocks, and commodities. So I think that's I for life I can't recall what it is, so I apologize, but I just know that's where you'll get the information for the COT hedge program ideas that I teach. Now, as you can see in this crude depiction here, the most recent in this example, as I'm hypothetically showing, is that they would be net short in their hedging program. Now, at that same time, where they're holding what would be deemed as a net short hedge program, this may actually be above the net zero line on a natural graph of COT data. In other words, the net trader's position chart, this whole business of up and down may actually be above the zero line, which would indicate a constant bullishness or net long position by the commercials. And in classic definition, that's true. But as I taught in the core content, that's not what I'm focusing on. I'm looking at the ebb and flow of what they're doing on a time basis. And why 12 months? Because everything is seasonal. So the factors that are seen in repeating over and over again, why are we even considering seasonal tendencies? Because there is a likelihood. It's not a panacea, it's not a be-all end-all, it's not a guarantee. It's the general roadmap of things might happen again because it's done this a lot in that same time of year. Now, by itself, it is absolutely no invitation for you to get in the market and take a trade. But when you group that together with the data ranges and the market structure ideas that I've taught you, then bringing in the economic calendar for a timing or smokescreen when they would facilitate that movement, you have just about as best a situation you can in terms of probability. So what would it look like in the price action? Price would have been going up, and primarily we're looking for some premium array. We traded above an old high, so we're looking at a liquidity pool. In this crude depiction, we had the market break down. Now in this price leg here, this is actually indicating like a daily chart. So all of this movement here would represent a daily chart. Inside of this leg here, from this low up to this high, when we went lower here, primarily there should be a short-term low that was broken, and then you would have a market structure break. Then this is a retrace back up, and that by itself is enough to look for a return back to a fair value gap that would be considered bearish. And you're coupling that with the COT hedge program. And on the monthly chart, we would expect the monthly range to expand to the downside. Okay, now again, we don't require that the market closes on that monthly range on the low or even lower. We just anticipate the movement to offer the opportunity. So just like I teach you in the low resistance liquidity runs in month 1, here is your sell stops. This is your sell side liquidity. The market would look to expand down over the course of the next 2, 3, 4 months, weeks rather, than make a monthly range, and we would be targeting these relative equal lows. So we're trying to sell near the high end of the range. What's the range? The low to this high. That is your dealing range. So you would be looking at this old low for an IPTA data range. How far back is that? Is that in the 20-day look back, or is that in the 40-day look back? How about this? And how about this? This low or equal lows, relative equal lows, that we're targeting here, that has to be within the constraints of the 60-day look back, the maximum. Okay. Otherwise, we would be forced to look at something like this low here if it was at the 60-day or less, or a 40-day look back. Okay, this could be a 40-day look back, and that would make it even better. For your notes, when we have these setups like this, we're looking for relative equal lows to be ran out for a low resistance liquidity run using this model and swing trading. If you can get these relative equal lows within 40 or 20, the probabilities of it getting there quick is higher than if it is on a 60-day look back. So ideally, you want to be looking at 20 to 40-day, but if you're forced because of the seasonal tendency and the market structure, you got to go as far back as 60 days look back. And as long as you have that low or relative equal lows in that range, in other words, if the 60-day look back is here, you can't say, well, here's 60 days look back, but this is really the equal low, so I'm going to go back there. No, you got to look at the 60-day and then consider maybe a fair value gap. Okay, don't get greedy. You might want to hold on to something like that, okay, and leave a piece on, but don't expect all of your trade to come off down here. Don't get greedy with that. All right, so we're going to identify the premium arrays inside of the 20-day IPTA data range when the COT hedge program is bearish, and we're going to expect a monthly range expansion down. Opposite is said here when things are bullish. We're going to identify the premium arrays above the 20-day, 40-day, or 60-day look back inside of the IPTA data range, and when this bias is bullish. So the scenario is such: COT hedge program, we split the last 12 months range on the commercial activity only. not factoring in large specs because they're going to always be a mirror image of what commercials are doing anyway because they provide the liquidity for the large funds. When the hedge program is bullish, looking back the last 12 months, the market has come down. It's taken out an old low. We've really pressed the market lower. And inside this swing from this high to this low, when this movement up here, there should be some kind of a short-term high over here that it broke. There's your market structure break. Market comes back down into a discount array. So we're going to be identifying the discount arrays inside of the 20, 40, and 60-day if the data range when the COT hedge program is bullish. That's this. Okay. We're anticipating and expecting the monthly range to expand up. We're looking for relative equal highs. This is going to be a liquidity pool. Now, if this relative equal high is outside of the look back period of 60 days maximum, this is just a pipe dream objective. You're going to have to look for where are the liquidity pools, old highs, or fair value gaps to target with this model. And while that may be something that trades to, we're looking to follow rules to have continuity and consistency as its goal. We don't just go in and say, okay, well, it looks like it's a double top here, and there's a buy stop there, so I'm just going to target that. How many times have we seen in recent years, and even in the commentary, I've even looked at specific levels like that and said it could get there, and it never went there. Okay, so it's something that's going to happen to you as well. So you have to stay within the guidelines of the data range between 20, 40, and 60. 60 is your maximum. As I mentioned earlier, when it was the model for when it's bearish, when it's bullish, the best scenarios are going to see your highs and or premium arrays that you're targeting inside of the 20 to 40 day. Now, I'm not trying to discourage you from trading using the 60-day look back. I'm just stating that you want to primarily focus your attention on the 20 and 40 and use the 60-day if the data range premium arrays in this case here as your best case scenario, and you're going to have very little on your position left at that point to be holding out for it anyway. So you're not going to be holding that level of the position that you started it with the expectation it's going to go to that objective, because that's just too myopic and silly to demand that of every trade, especially with swing trading, because it could change on a dime on some kind of news like the coronavirus at the time of this recording. All right, so trade planning. When the market is primed, we want to look for convergence of both manipulation and price opposite to our trade bias at a time the economic calendar suggests volatility injection will likely unfold. We will short bearish optimal trade entries and buy bullish optimal trade entry setups. When we are bearish, we will frame a short entry when price has moved up into a 15-minute premium PD array that converges at a standard deviation of no more than +3 standard deviation, and that's going to be in the form of the Asian range, central bank dealers range, or flout, using the rules for that selection. And I gave you those in the core content, so you'll have to go back into your notes and get that. During London Open and or New York Open at the 62% fib level of the optimal trade entry. So we're looking for a confluence of our entry at the 62%, and it has to converge within 5 pips of your standard deviation +3. We're going to be implementing, or we can rather, implement scalping protocols at this stage for further reduction in risks. In other words, the things that you would use for your scalping on a 5 and 1 minute basis, or that approach to doing it, you can further reduce it from using our 15-minute time frame here down into a 5 or 1 minute chart, allowing your stops to be even more reduced in terms of risk. When we are bullish, we will frame a long entry when the price has moved down into a 15-minute discount PD array that converges with a standard deviation of no more than -3 standard deviations. Again, the standard deviations are based on Asian range, flout, or central bank dealers range. I gave you rules to know which one you would focus on. There has to be a confluence between that and during the kill zone of London Open and New York Open, and at the 62% fib level. So if we're using the 15-minute time frame, what am I saying? You're going to look at the price swing on a 15-minute time basis. In that 15-minute chart, your fib level is going to be pulled from the low formed at the 15-minute time frame during the London Open, and it rallies up, breaks the market structure, comes back down, wherever that 62% retracement level is, it should line up with no more than 3 standard deviations down. So there's your clue. Which one of the 3 do you use? Central Bank Dealers Range, Flout, or Asian Range? Whichever one converges with that idea. Uh-oh, light bulb just went on. We can implement scalping protocols on this stage as well for further reduction in risk. So what I said mentioned in the previous slide, when we were referring to it as when it's bearish, everything that I taught how to use in terms of the 5-minute chart and 1-minute chart, you could use here and reduce the risk that would be seen otherwise on that 15-minute chart. Break it down, that way you can use larger leverage but still keep the relative risks the same, if not lower. When we are bearish, we will target the sell side liquidity below any old daily low or fair value gap inside of the 20, 40, or 60-day IPTA data range. As I mentioned in the slides when I was showing you the COT hedge program, outlining that as individual general templates, that's what I'm talking about there. So go back to that slide and listen to that again if you don't understand what that is, because all I'm doing is referring to what I just said at that time. The immediate or next logical discount array will be the initial objective. So that means your low in the last 20 days, that's going to be your first objective. Now, if it's too small of an objective, what is that? Well, it's all going to be relative to what you want to make and how you want to manage your trade. The low inside of the last 20 days may not be sufficient enough for you to take your first profit for you. In other words, it won't appease you. It won't be, it may not be even 40 pips. So maybe your first scale is 75 pips. Why 75 pips? Because as a short-term trader, that's your high-end pip haul, or at least that's how I interpret it, because I look for 50 to 75 pips a week. So I use what I would expect as my maximum weekly one-shot, one-kill. That's my first take profit or partial when I'm swing trading. I demand that at minimum. So whatever that is in terms of the 20 or 40-day IPTA data range, that low that you're looking at or fair value gap, it has to offer that for you. Now, don't use that as a gospel, like it has to always be just that. Fine tune it where it meets your personality. You feel comfortable with it. It may not be 75 pips. It may 50 pips is good for you. It could be a good partial right there. You banked something, move your stop accordingly. As we'll touch base and cover in a couple minutes when we get to that slide. But you want to have your ideal initial objectives mapped out on your chart, on the daily chart, and they're determined on the daily, not your 4 hour, not your 1 hour. Your partials are scaled and scheduled on that daily chart. So you're not trying to guess as trades go on, or you get caught by an expansion real fast and you're thinking, okay, well, I'm going to just keep on holding what I got. No, you have to be sober-minded about it, because if you don't, many times you're going to see trades turn on you in swing trading, and you'll have to sit through longer periods of drawdown. And if you didn't, well, not drawdown, but a retracement, so you may have open profits but may have given up a large portion of them. So if you take your logical scalings and mark them on your daily chart, when price gets there, you'll know that that's what you should be doing. Okay, and when we get to our orders, you'll see that we have already made concession for that, as we've done in the previous models. There will likely be multiple old daily lows inside of the IPTA data range. That means the last 20, 40, and 60 days. But we use the one that frames the potential of at least 100 to 300 pips, because that's this model's objective. When we are bullish, we will target the buy side liquidity above any old daily high or fair value gap inside of the 20-day, 40-day, and 60-day IPTA data range. The immediate or next logical premium array will be the initial objective. So everything I mentioned in the previous slide regarding the definition, or what would define your initial objective for scaling out your first profit, that's what I'm referring to here, just only when we're looking at from the scope of being bullish. So you have to identify your old high or your premium fair value gap that you're expecting price to rebalance to. That has to meet your minimum objective for an initial target. So again, mine is for swing trading 75 pips. So if it's not allowing that, you got to look back further than 20. You could look back into 40 and then up to 60 days. So, but you want to have, again, mapped out where on the daily chart, not the hourly, not the 4 hour, not the 15 minute, the 5 minute. You're looking for your logical scaling objectives on the daily chart, because that's exactly what we're trading. We're trading the daily chart with the expectation, the bias of the monthly range. There will likely be multiple old daily highs inside of the IPTA data range, but we use the one that frames the potential for at least 100 to 300 pips. When we are bullish, we will note the European open price on Tuesday and filter all longs at or below this price level. We will anticipate a 15-minute optimal trade entry to form inside of a retracement lower during London Open and or New York Open kill zones, or a sell stop rate. That means a run on a very low level 15-minute equal lows. It could, trade below that, take the stops there, and then reject. Now, you may not feel comfortable taking that trade. You would then wait for that to occur and then wait for a market structure shift on the 15-minute time frame, or once you get the raid below the equal lows on your 15-minute time frame, then you could drop down into a 5-minute chart and use your scalping setups. Everything is plug and play, like I promised, but you have to know the core content well to know what I'm showing you here. But everything I'm showing you here is basically what I do when I'm giving you the commentary on the Wednesdays and the weekends. I'm using these ideas to flesh out what I'm saying to you, and then that's why the market trades the way it does. Alternative trade executions. Now, this could be viewed as if you missed the optimal trade entry, or your order didn't get filled because your spread didn't allow for it. Alternative trade executions here for when we are bullish. We will note the Asian range high on Tuesday and place a buy stop at this level plus 1 pip after 2 a.m. Eastern Standard Time. We will anticipate a price to have made the low of the day after price starts its decline under the Asian range low and or European opening price. Trade executions. When we are bearish, we will note the European opening price on Tuesday and filter all shorts at or above this price level. We will anticipate a 15-minute chart optimal trade entry to form inside of a retracement higher during the London Open and or New York Open kill zones, or a buy stop rate. In other words, running out buy side liquidity, relative equal highs, wait for that to run those, and then if it does, it starts to drop lower, we can get a market structure break there. Then you can look for the fair value gap to form in that, or drop down to a 5-minute chart and use your scalping protocols to get you in on the short. Okay, alternative trade executions. When we are bearish, we will note the Asian range low on Tuesday and place a sell stop at this level minus 1 pip after 2 a.m. Eastern Standard Time. We will anticipate a price to have made the high of the day after price starts its ascent above the Asian range high and or above the European opening price. Short trade management. When we are entering a short, we will place a sell limit order on all positions we will execute with our demo account. We will use the standard deviation and PD array convergence minus 5 pips as our entry price when using the sell limit order. If multiple orders are used, all use the same entry price in the sell limit order. When we are entering a short, we will place a limit order to take 50 pips. We're using that as an objective for the low end. Remember I said the weekly one shot, one kill, my target range is 50 to 75 pips. Now you see why I have these here. It wasn't just willy-nilly picked out because of the previous model. Everything's framed on the context of how I trade. You signed up to learn how I look at, interpret the market and analyze it. This is how I do it. Taking 50 pips as objective 1. We will take a second order and take 75 pips as a second objective. We will use multiple orders to manage the trade idea. If you capture a 300 pip objective, close 80% of the trade and see if it has any more room to run. Now, this slide here, you can fine tune this. You can say where I have 50 pips as your initial objective on one of the limit orders, okay, that could be your 75 pips. then the next one where I have 75 pips, you can actually make that 100 pips or 125 pips or 150 pips, whatever lines up with your next discount array or old low or old discount fair value gap that you would be aiming for when short, found on that daily chart. But as a general rule of thumb, you may elect to have your first objective be 50 pips, as I said earlier in the discussion. Me personally, mine would be 75 pips, then 130 pips. Why 130? It's just something I've done for a long time. We will use multiple orders to manage the trade idea. If you capture a 300 pip objective, close 80% of the trade and see if it has more room to run. What do I mean by that? If you have multiple orders, and if you've used two to get first and second objective, we're implying or assuming here that you've used 3 orders to put on this trade, so that way you can manage it. When you have this set up like that, you're able to leave that third one on to see if it is basically caught a tiger by the tail. If it starts running, you can open up your objective to be open-ended and then manage to trade with your stop loss. You can put some crazy wild objective like 500 pips as a best case scenario. It may never even get there, but in environments like we're in now in 2020, we've seen some pretty astonishing moves. Over 3,000 pips in Euro Aussie. So by having that one leader in there, okay, in other words, leaving a line in the water, if you catch a runner and that market starts to take off, why would you want to limit your profit objective to just 300 pips? That's the ideal scenario, 100 to 300. But if we are in a high probability seasonal tendency and the market structure is implying that your direction is probably right, and that monthly range really expands, that monthly candle could really open up and give you 1,000 pips or so. So you want to make yourself available to capturing that move and not strangle your position and get out too prematurely on your last portion. When we are entering a short, we will note the premium array and standard deviation convergence we aim to enter at. We will place our stop loss above this high plus 25 pips. We will re-enter if the trade stops out. Now notice we said we're going to re-enter here. Why? We're going to be monitoring if we get stopped out for a secondary entry, because swing trades may require multiple attempts to secure a solid entry. Do not fear this, especially if you're going to really hone in on this as your bread and butter approach to trading and you're not going to be a short-term trader or a scalper or a day trader. You're going to have to accept the fact that your win-loss ratio is going to be lower in this model, because number one, you're going to be waiting a lot more time for setups, and you're primarily going to jump the gun a lot. You're going to be fearful of missing the move, so you have to make a plan for that. In other words, plan for stuttering. Okay, plan for the inability to nail down the absolute best entry and then riding it all the way out, because that's not realistic, especially as a developing trader. So what does that mean? You definitely want to keep your risk low as a swing trader, because you're trying to capture big moves. So you don't want to offer too much risk when you do these. Whereas if we did short-term intraday trading, you can trade with a little bit larger spectrum of risk, because your win to loss ratio should be higher, and your frequency of waiting for another setup is very, very slim. It's probably the next trading session, not even the next day. So with this model and this approach to trading, you want to be sure that you have the personality trait that allows for and is comfortable with being wrong more often than you probably would think you would be if you sat down and say, okay, I'm going to be a trader. Traders are 90% accurate. They always make money, and they're only losing a little bit of time. You can't think that way as a swing trader, because swing trades are going to come back on you quickly. If you're too aggressive about managing your stop loss, you'll get stopped out prematurely. And what do? Do you forget the whole idea? You can't do that with swing trading, because if you let one trade stop out to undo what you have made in terms of your top-down analysis, then you're not doing it correctly, because what led to that setup in your mind to be bearish? Because you're looking at the expectation of that monthly range expanding down. You're looking for a minimum of a weekly expansion down, if not a series of them, to make that monthly range go lower. And if you get stopped out, what has fundamentally changed about the situation? Probably nothing, except for the fact that you strangled your trade and got stopped out prematurely, or entered in too soon, fearful of missing the move. Okay, so you have to allow for that. Don't fear it, because you're going to most likely see that it's going to take you multiple attempts to secure the ideal entry that you're looking for. And really, in swing trading, you're probably not going to get a lot of the ideal entries. Many times you're going to be looking at it because it takes off and you've missed the ideal entry, and you'll have to use some kind of a retracement to a fair value gap anyway. Long trade management. When we are entering a long, we will place a buy limit order on all positions we will execute with our demo account. We will use the standard deviation and PD array convergence plus 5 pips as our entry price when using the buy limit order. If multiple orders are used, all of the same entry prices are used for the buy limit order. When we're entering a long, we will place a limit order to take 50 pips. Again, these are flexible now. These are just suggestions. Take 50 pips as our objective on one position. We will place a second limit order to take 75 pips as our secondary objective. And if you have 3 orders on, you leave that one on to capture a 100 pip objective, and or lock in at 100 pips and then leave that open-ended portion like we were mentioning when we were looking at the short slide. You don't want to strangle your trade. So how you set these parameters up, they're going to be distinct to you, unique to you. Okay, so that portion of this trade plan is going to have you entering what you feel based on what the market structure is implying, what's the 20, 40 day, and 60 day if the data range make available for you. Where are the premium fair value gaps that you would look for to retrade back up to and rebalance? Where's the old highs that you expect them to trade to and above for the buy side liquidity pools? Wherever they are, you're going to be using that in reference to what these profit objectives would be, but always leaving room for an order to run beyond the scope of 300 pips. But you want to capture, in one of these orders, you want to capture at least 100 pips. That's a medium objective. You want to try to at least get that somewhere. Now, that may be, for some of you, your first profit objective. Some of you may say, no, I have to be getting 100 pips, because if I'm going to be risking 25 pips, I need to be trading better than 3 to 1, and that would be 4 to 1. So all these things, again, allow for your unique fingerprint on it. I'm just giving you a rough idea, and then you're going to take these models and you're going to gravitate to one of them and say, okay, I like this, but I'm going to include this, and I'm going to change and tweak that, and not do it so wildly that it turns into something that's unlikely to occur. When we are entering a long, we will note the discount array and standard deviation convergence we aim to enter at. We will place our stop loss below this low minus 25 pips. We will re-enter if the trade stops out. We can monitor it for secondary entries. Why? Because swing trades may require multiple attempts to secure a solid entry. Again, do not fear this. If you're going to trade swing trading, expect to lose. Expect to lose, because you're going to lose, and just because you got stopped out or you missed the trade, your ideal entry, don't abandon the idea, because think about it. You are doing an analysis with the assumption that the market's going to move in upwards of 300 pips or so. So if it's moved from where you're trying to get in at, and it's only done so in a capacity of 30 to 40 pips, have you missed the trade? No, you just missed one entry point. That's the reason why I state that learning short-term trading and scalping will facilitate ideal entries that are after your ideal swing trade entry. You follow what I'm saying? So if you were looking at the daily setup in the daily market structure on that daily chart, and you were honed in on a specific price level that was a fair value gap or something that of that idea or mindset, you may not have been able to capture that entry point. So the market starts to move down, and it moves 30, 40, 50 pips. But you have done your analysis, and it suggests that you have 200 or more pips to go on the downside, or in this case, long up above us. It could run that much more. Do you abandon the swing trade idea because you didn't get your perfect entry? No, absolutely not. That's the benefit of understanding institutional order flow and using the institutional order flow entry drill, because you can get in sync with a move that's already happened and starts to unfold, where other people would say, I missed my entry, I'm scared now, like deer in headlights. We don't have that problem. You don't have to have the best entry. You don't have to have that. And that's what my core content teaches you. Like, you can literally sit down and plug yourself into any market environment and say, okay, this is what it's doing, this is where it's going, and where can I get in right now and be a part of that move? And it may still be a swing trade that's unfolding, but you just didn't get at the highest high or the lowest low. So again, price action is fractal, and understanding it with a well-rounded, comprehensive approach like I'm teaching you, you will have no fear of missing moves. You won't feel rushed to get in, and you'll understand what it is you're looking for and why you're doing it. Stop loss management. When we are in profit, 25% of our expected objective stop loss can be reduced by 25%. That means you're still holding open risk. That is a little unnerving. It doesn't fit my particular risk appetite, but this is the model. Okay. When we are in profit, 50% of our expected objective stop loss can be reduced by 50%. When the position is at 75% of the expected profit objective, stop must be at break even or better. Don't try to strangle the trade. Now, this same stop loss management is universal. Every model has the same one. It's the same way. The reason why is because I'm not trading my stop loss. I'm not worrying about my stop loss. The stop loss is there to do its job. What I'm trading is the future delivery of price. And is it still giving me the signatures I'm looking for? If I'm bullish, is every down close candle supporting price? Is it rejecting and moving higher? If it does, is it breaking through up close candles? Because that is institutional order flow as I define it. That's mine. That's my interpretation of how you can see visually how large institutional flows are coming in and sending the market higher. If we start to see up close candles start keeping price from going through them, we're starting to see institutional order flow slow down on the buy side, and sell side may start to ramp up, and it may start to create a imbalance and then break lower. So what we're doing is we're reading that, and by not worrying about your stop loss and having protocols in place, ultimately, look, there's risk always. And you don't want to be worrying about, are you going to get stopped out prematurely? So using this model here, you're never going to worry about that. But you're always going to have concern that you're going to take a loss. But that's what we always have to incur when we take trades. You're always going to likely lose in a position because every trade starts as a loser. You have to overcome that spread. So, and if you're not trading Forex and you're trading futures, you have to overcome your commission. So you always have something to overcome. Every trade opens up as a losing position, and you have to trade your way on the opposite side of that. Not worrying about your stop loss is one of the best things you can do in your formulation of a trade plan, and these are universal protocols for that. Money management. These are the same slides, so I'm not going to read this because I don't want to do it. I'm being nonconformist. You can read it just as well as I can say it. And not all these slides are, again, reinforcing the idea of what you're doing. Every number in here is replaced with what you would be utilizing in terms of equity. So if we're looking at, in the case here, 20,000, most of you probably wouldn't start with 20,000. It would be 5,000. So the 5,000, you would do the math that's shown here, and they would give you new figures, and then you would use that to determine how much you would trade with. Now, you can go online and get leverage calculators online for free, and use Google Forex leverage calculator, and you just put in how much money you have, how much you're willing to risk, and what stop size are you trying to trade with based on what you're seeing in the market. And it'll tell you all this information here. So while all this is still useful, it's not really necessary in today's climate because you have so many tools that are readily available to you for free. You can go on there and just Google it. but it just gives you an idea on how to do it by hand, so that way you don't have to depend on some outside reference or resource. And just for completeness sake, I'm just toggling through it, and nothing's really changed. So if your demo account takes a loss on a trade, I want to talk about this because this is really important, and you're using your full %R that your trade opened up with. In other words, if you're using a maximum 2%, which I don't think anybody should do as a swing trader, you should never do that. 1% or less, if that's going to be the way you're going to trade with, because remember, you're going to take potentially multiple hits going in, and you're expecting the long haul trades to pan out. And if you're using a 25 pip stop loss, it gives you a huge upward R multiple for profit potential. And again, my example would be to refer to Euro Aussie in recent months or recent weeks here during the month of March, where it exploded on the upside. And I taught you that as we were going through the markets. I showed you how to find relative strength and how to look for the leadership currencies. In that I showed you which one was going to outperform all of them, and it did by 3,000 plus pips. There's no other currency out there that did more than that. So if you use that as your basis, okay, because that's your quarterly move for the first quarter, that was your mega trade, okay, for the first quarter of 2020, Euro Aussie. How many pips did it move? 3,000 plus. So if you nail down an entry with 25 pips as your stop loss, say you took a loss, say you lost 3 trades in a row, okay, 1% you took on the first trade, you lose. So you got to drop it down to 0.5%. You get another hit, boom. Now you can only risk 1/4 of 1%. That's not a lot. That's not a lot of money, Michael. I can't make money with that. Well, too bad. You got to change your perspective on that, because you're not trying to get rich quick. You're trying to survive to that, for you to allow yourself the time and opportunity to catch these big moves. If you had 1/4 of 1% risk after you've taken 2 losses, you're only in the hole 1.5%. So it doesn't take a lot for you to get out of that. But now you're trading with 1/4 of 1% leverage. What have you done? Each time you took a loss, you dropped your R by 50%. And you cannot increase that back up until you recoup your previous loss by 50%. So what that does is it allows your equity to not see these big roller coaster dips. Okay, you'll go up, and once you start making money, you're going to anticipate losing eventually. Okay, you're going to scale back. But if you do take a loss, in this example, imagine if you got in with a 25% of 1% leverage using a 25 pip stop loss on a move like Euro Aussie. Now, yes, we're hypothetically speaking, okay? This isn't always going to create 3,000 plus trades, but if you risk 1/4 of 1%, and you have that 1/4 of 1% spread over 25 pips as your setup and stop loss, and it moves 3,000 pips for you, what's the R multiple on that? It's astronomical. So you'll make back your 1.5% loss plus a huge R in return, even though you've used 1/4 of 1%. That's how you swing trade. You want to swing trade the mega trades or the quarterly shifts. If you don't know how to do that, then you don't want to be trading swing trading. You want to be trading short-term trading until you get good at understanding what the swing trades setups are. So dropping the R percent by 50% when the loss is recovered by 50%, in other words, if you lost $200 and then you're able to make $100 of that back, then your next trade you can go back up to your previous risk exposure. It would be 1% for swing trading. If the reduced R trade assumes a loss, you reduce it, like I was explaining just a moment ago. We went into the trade idea hypothetically with 1%. If we take a loss, we drop down to 1/2 of 1%. If we take a loss again, we drop down to 1/4%. And you stay at 1/4% until you make the loss that you took at 0.5%. 50% of that loss that you took when you're using 1/2 of 1%, when that's made back, then you can trade back to 1/2% leverage. And the same thing is said when you make 1/2 of the loss you took at 1% back, You're not expecting to make it all back, just 50% of it. What this does, it smooths your equity curve out, and you don't get that real big up and down roller coaster ride. You don't get huge drawdown, shock and awe scenario. You don't get scared out of taking the next trade because you're controlling not only yourself, but you're trading your equity curve. Think about that. You're not trading your stop loss. You're focusing on delivery of price. Is the market giving you what you're looking for in terms of institutional order flow? And you're trading your equity curve. That is how you throttle back your leverage. You don't say, man, I'm really killing it. I've had the last 18 trades that were winners. I'm going to go in full bore 5% risk. I've done stupid stuff like that. Okay, I've done 20% risk on trades when I was a commodity trader, and I got my rear end handed to me. Okay, it never, ever, ever works. Murphy's Law, whatever can go wrong, expect that plus more. That's the kind of pain that can come. So you have to have all these protocols in place, and it will preserve the likelihood for you to capture big moves, but it doesn't guarantee it. But if you don't do these things, I can guarantee you'll never make them. Now, if you take a series of 5 winning trades in a row, you're going to drop your R percent by 50%. It's just like if you took a loss, because you're expecting to take a loss, and you don't want to eat up the 5 winning trades that you've built your equity up with. You don't want to take the next loss with your maximum risk exposure. So again, we're creating plateaus in our equity curve. It's going to go up like a staircase. It goes up, then it goes sideways to up. And if it starts to drop down, it won't go down much. And then you get another rise in equity, and you keep doing that. It is control of self. It's discipline. You are trading equity. You are trading probabilities. You are not trading emotion. Emotion comes by saying, I always use the same leverage. I always take the same size trade. That's dumb. That's dumb. That type of thought process is going to ruin you, because you're going to get caught up in the feel-good moment of what you just did in the last 6, 7, 10 trades. And if you get a hot, lucky streak, and everybody's capable of doing it, you're going to break rules that are going to lead to you losing. Because what's going to happen is, for instance, you had 5 winning trades in a row, and you feel good. You got that King Kong feeling. You're beating your chest. You want to go online, tell everybody how good you are, show everybody your winning trades, even show where you went in and got out at. Your screen captures. That's the one everybody puts out there on the internet. The next trade you take is going to be a losing trade. Well, you can't show that online, and you can't show that to your spouse, and you don't want to see it. So what are you left with? You're internally wrestling with that. I should have never did that. I got to fix it. Well, now you created a whole paradigm of the loser cycle. You don't want to enter that. So the way you compete with that natural tendency is, after you take 5 winning trades, cut your highest maximum leverage that you usually would start with, cut that in half. Whatever that is, if it's 1%, then on your 6th trade, after 5 winning trades, you drop down to 1/2 of 1%. Period. End of story. No discussions. That's the way it is. Because if you take a loss, you've only lost 1/2%. And then when you drop down, what are you going to? You're going down to 1/4 of 1%. If you're entering a period of drawdown, how much are you losing with 1/4 of 1%? Not much. And you're not going to lose any sleep over that. It preserves your equity, and it preserves the mental capital that you need, because once you start losing money and you get that toxic feeling of I'm losing, you can forget about it, because you're going to see things in price action that aren't really there. And you're going to get scared out of trades because, okay, I just made $50 out of the $100 out of this loss. I can't let this go down. I got to get out. I just can't stand anymore. And you close the trade. And then it runs to your objective many times beyond that. And then you're going to think about that instead of taking the next trade. And it's toxic thinking. That's what these things help you do. If you want a smooth equity curve, this is how you get one. There's no other way for it. There's no other super technique. There's no secret science. There's no... there's nothing out there but just this. This is how it's done. Period. End of story. No one else is doing it any other way. This is how you manage yourself. You manage your emotions this way. You manage the trade psychology this way. You manage your self-discipline this way. You have to execute with this in mind. If you don't, you're going to lose, and you're going to lose more money because you're going to throw fearful trades on or stand on the sidelines when the next trade setup's there, and you won't take the trade, and it starts to pan out, and then you say, oh, I should have done that. Then you chase price because you're in pain, and then you go through that loser cycle again, and it creates drawdown that nobody wants to go through. But you're going to have measured drawdown your entire career. You're always going to have losing trades. Every single trade opens up as a loser, and you got to trade your way out of that. How you do it over a long period of time, well, that's your career, but you're going to have a lot of losing trades. But if you let these losing trades that come in by natural order of things, it's a natural process. It's the business cost of doing this, okay? You will absolutely survive if you do this. Now, notice what I said. I didn't say you're going to be a multimillionaire in 6 months. I didn't say that. I said you're going to survive if you do this. Over time, the experience factor will kick in, and then you'll see where your sweet spot is in analysis and what you're looking for all the time as setups. And that is the model that you will stay with the rest of your life. You won't change it. You won't tweak it. You don't care what anybody says, even me. And you'll just be consistent, steady Eddie, okay? You'll be on your path to take wherever your objective is. That's the vehicle you'll use to get there. Now, with all of this, like everything else I've shown in Model 2 and Model 1, you're going to collect a month or two of sample sets with this trade plan. Now, if you're unclear about some of the processes here, you're going to rewatch the lessons on this price action model. In other words, all the components, the things I'm talking about here, go back into your core content and revisit those ideas. And it'll reset your mindset about what I'm referring to, and it fills in those gaps. I will provide sample sets. I know I haven't done yet for Model 2 or 1, but it will happen. I'll provide sample sets, but do not rely on me or wait for mine. Dig into your charts and study what is provided here. Good luck and good trading.